Let me ask you something. If the IRS quietly updated a retirement rule that could potentially cost you up to 25% of your savings, would you even know it happened? Right now, millions of Americans age 72 and older, as well as people who inherited retirement accounts from someone in that age group, may be facing a costly IRS requirement without realizing it. There's no breaking news alert, no warning letter from the government, and no phone call from your financial institution. For many people, the first sign that something went wrong is the penalty itself. In today's report, I'll explain exactly what changed, who these updated IRS rules apply to, why so many retirees are being caught off guard, and the practical steps you can take today to protect your retirement savings and avoid an expensive mistake. Stay with me until the end of this video because the last section is the most important part. I'm going to give you a step-by-step checklist that could literally save you thousands of dollars. Let's get into it. Who is this about? Set the stage. First, let's make sure we're all on the same page. If you have a traditional IRA, a 401k, a 403b, or a similar tax-deferred retirement account, this video is for you. If you inherited one of those accounts from a parent, a grandparent, or a spouse who had already started taking withdrawals, this video is especially urgent for you. And if you're over the age of 72 or approaching it, you need to pay very close attention to what I'm about to say. Here's the background. When you put money into a traditional IRA or 401k, you got a great deal from Uncle Sam. Your contributions went in before taxes and your investments grew without being taxed year after year. But here's the catch. The IRS built into that deal from the very beginning. Eventually, they want their cut. They're not going to let that money sit in your account forever, growing tax-free while they get nothing. So, they created what are called required minimum distributions, or RMDs. And RMD is exactly what it sounds like. Once you hit a certain age, the IRS requires you to withdraw a minimum amount from your retirement accounts every single year. You pay income tax on that withdrawal. The government gets their money. For decades, that age was 70 and a half. Then Congress changed it. Then they changed it again. And here's where people start getting lost in where the IRS starts collecting penalties, the age confusion trap. This might be the single biggest source of confusion for retirees right now. And honestly, I don't blame anyone for being confused. The rules kept changing. Here's the timeline. Before 2020, you had to start RMDs at age 7. 2020 onward, the Secure Act raised it to 72. 2023 onward, Secure Act 2.0 raised it again to 73. 2033, it's scheduled to go to 75. So right now, in 2026, here's what matters. If you were born before 1951, you should have already started taking RMDs. If you were born between 1951 and 1959, your RMD start age is 73. If you were born in 19,960 or later, your RMD start age will be 75. Now here's where the confusion turns into a penalty. Some people, especially those who turned 72 in 2022, got caught in the middle of these rule changes and they thought they had to start at 72 and then they heard the rules changed. So they stopped or they never started. Or their financial advisor told them something different, and the IRS doesn't care about confusion. If you were supposed to take a withdrawal and you didn't, that's when the penalty clock starts ticking. The penalty and why it feels brand new. Now let's talk about the actual penalty because this is what the title of this video is about, and I want to be completely honest with you about what's happening here. The IRS penalty for missing an RMD isn't brand new, but it changed dramatically. And the enforcement just kicked into high gear in ways most people didn't see coming. Here's the history. For years, decades actually, if you missed a required minimum distribution, the IRS penalized you 50% of the amount you failed to withdraw. That's brutal. And it was meant to be. It was one of the harshest penalties in the entire tax code. But then Secure Act 2.0 came along and reduced that penalty to 25% of the amount not withdrawn. And if you correct the mistake within 2 years, it drops further to 10%. Now here's why people are calling this a new penalty and why this video matters so much. Right now, for the past several years, the IRS had been granting grace periods. Specifically, they issued notices. Notice 202253, Notice 202354, and Notice 202435 that basically told certain people, "Don't worry, we won't penalize you this year. We're still figuring out the rules." Millions of Americans, especially those who inherited retirement accounts, got used to those grace periods. They assumed the flexibility would continue. But as of January 1st, 2025, the grace period is over. No more waivers, no more notices, no more "we'll let it slide this year." The IRS finalized its regulations under what's called IRS Final Regulation TD 1001. And enforcement is now in full effect. The penalties are real, the deadlines are real, and most people have absolutely no idea. The inherited IRA bombshell. Okay, this next section is probably the most important thing I'm going to say in this entire video. I need everyone watching to pay close attention, especially if you've inherited a retirement account from a parent or a loved one in the last several years. This is the quietly added part of the IRS rule that most people truly have no idea about. Here's what happened. Before 2020, if you inherited a retirement account from a parent or relative, you could take out small amounts over your entire lifetime. It was called a stretch IRA because you could stretch the distributions out over decades. This kept your tax bill low every year and let the money keep growing. The Secure Act of 2019 basically killed the stretch IRA for most people. Under the new rules, most non-spouse beneficiaries, meaning adult children, other family members, friends who inherit a retirement account after 2019, must empty the entire account within 10 years. That's already a significant change. But here's the trap. Nobody saw coming. For the first few years after this rule passed, there was genuine confusion about whether you had to take money out every year during those 10 years, or whether you could just wait and empty the whole thing in year 10. The IRS issued conflicting guidance. Financial advisors were divided. And so the IRS said, "We'll waive penalties while we work this out." People interpreted that as flexibility. Some waited, some took nothing. And then the IRS finalized the rules in 2024. And those rules said this: if the original IRA owner had already started taking RMDs before they died, you as the beneficiary must also take annual RMDs in years 1 through 9. And you must empty the entire account by the end of year 10. You cannot just wait until year 10 and pull everything out. If the original owner had already begun their required withdrawals, you must continue taking annual distributions. And if you didn't, starting in 2025, there is a 25% penalty on every dollar you should have withdrawn and didn't. Let me give you a real example. So, this hits home. Say your mother passed away in 2022. She had a $400,000 traditional IRA. She was 76, meaning she had already been taking her RMDs for several years. You inherited that account? You heard about the 10-year rule and assumed you just had to empty it by 2032. So, you didn't touch it. Here's what the IRS now says you should have done. Based on the account balance and IRS life expectancy tables, you may have been required to take somewhere around $15,000 to $20,000 per year starting in 2023. If you miss 2023, 2024, and 2025 distributions, you could be looking at $45,000 to $60,000 in missed withdrawals. And a 25% penalty on that amount is $11,000 to $15,000 on top of the income taxes you'll owe when you eventually do withdraw. And here's the part that really stings. The IRS waived 2023 and 2024 for this scenario, but 2025, that deadline was December 31st, 2025. That ship has sailed. If you are in this situation right now and you haven't taken your 2025 distribution or you're behind, you need to talk to a tax professional immediately. There is still a correction window where the penalty can be reduced from 25% to 10% if you act within 2 years, but you need to act. The IRS is no longer being patient. Common mistakes people are making right now. Now, let me walk you through the 5 most common mistakes people are making right now, because if you know what they are, you can avoid them. Mistake 1, assuming someone else is handling it. I hear this one all the time. Oh, my brokerage handles my RMD automatically. Maybe some custodians do calculate and send RMDs automatically. Many don't. You need to verify in writing that your custodian is calculating your RMD and processing it by the deadline. Never assume. Mistake 2, thinking the 1-year rule means no withdrawals until year 10. This is the inherited IRA trap we just talked about. The 10-year rule does not mean you wait 10 years and then empty the account. If the original owner was taking RMDs, you must take annual distributions too. Many people got this wrong, and the IRS grace period covered them for years. That grace period is now over. Mistake 3, missing the April 1st deadline for first-timers. Here's a quirk in the rules that trips up first-time R&D takers. In your very first year, the IRS lets you delay your withdrawal until April 1st of the following year. So if you turn 73 in 2025, you have until April 1st, 2026 to take your first RMD. Sounds great, right? Except here's the trap. If you wait until April 1st, you still have to take your second RMD by December 31st of that same year. So you end up taking 2 distributions in 1 year, which means double the taxable income, which could push you into a higher tax bracket, increase your Medicare premiums, and even trigger taxes on more of your Social Security. Mistake 4, forgetting multiple accounts. If you have multiple IAS, you have RMD requirements for each account, though you can sometimes combine them and take the total from one account. And with 401ks, it's different. You generally must take the RMD from each plan separately. If you have accounts at multiple institutions, it's very easy to overlook one, and the IRS doesn't overlook anything. Mistake 5, ignoring the Roth 401k change. Here's actually some good news buried in all of this. Starting in 2024, Roth 401k accounts no longer require RMDs during your lifetime. This is a major change. Previously, Roth 401ks were the one type of Roth account that did require distributions. Now they're treated the same as Roth IAS. If you have a Roth 401k and you've been taking RMDs from it out of habit or confusion, you may no longer need to talk to your financial advisor. How to protect yourself, your action plan. All right, this is the section I promised at the beginning, your step-by-step protection plan. Let's go through it. Step 1. Know your RMD age. Based on your birth year, confirm exactly when your RMDs must begin. If you were born in 9951 or before, you should already be taking them. Born between 99951 U.S. 1959, your start age is 73. Born 1960 or later, it's 75. Write this down. Know your number. Step 2. Contact your account custodian. Call or log into every retirement account you own. IRA 401, K43B, SE IRA, Simple IRA. Confirm whether they are calculating and distributing your RMD automatically or whether you need to initiate it. Get this confirmation in writing or by email. Step 3. Audit any inherited accounts. If you inherited a retirement account from someone who passed away in 2020 or later, you need to determine did they die before or after they started taking RMDs. If they had started taking RMDs, you are likely required to take annual distributions in years 1 through 9, and you must empty the account by year 10. If you haven't been doing this, contact a CPA or tax professional immediately. The correction window where the penalty drops from 25% to 10% requires you to file IRS Form 5329 and take the misdistribution within 2 years. Step 4. Consider Roth conversions. If you're in the gap years, meaning you've retired but haven't hit your RMD start age yet, this is actually a powerful planning window. You can convert some of your traditional IRA to a Roth IRA, pay taxes now at lower rates, and reduce the size of future RMDs. This is a strategy worth discussing with a financial planner. Step 5. Look into a QCD qualified charitable distribution. If you're 70M or older and charitably inclined, a qualified charitable distribution lets you donate up to $105,000 directly from your IRA to a qualified charity, and it counts toward your RMD without being added to your taxable income. This is one of the best-kept tax secrets in retirement planning. Step 6. Mark your calendars. RMD deadline for most people, December 31st every year. First year exception, April 1st of the following year. But remember the double distribution trap. Put these dates in your phone. Set reminders. Don't let a deadline sneak up on you. Step 7. Work with a professional. I know this sounds like a plug, but I'm being serious. The rules around RMDs, inherited IAS, and tax planning in retirement are genuinely complex. A good CPA or fee-only financial advisor who specializes in retirement accounts can potentially save you 10 times their fee and avoided penalties and smarter tax strategies. Before I wrap up, I want to give you a bit of context because I think it helps to understand why this is happening. The federal government faces an enormous fiscal challenge. Trillions of dollars are sitting in tax-deferred retirement accounts. Money the IRS has essentially been promised but hasn't collected yet. As the baby boomer generation ages, there is significant interest in making sure those accounts get distributed and taxed in a timely way. That's why the stretch IRA was eliminated. That's why the 10-year rule was enacted. And that's why the IRS spent 4 years finalizing these regulations and is now fully enforcing them. The grace period was never meant to be permanent. It was a transition. The transition is over. And with more complex rules and tighter enforcement, the chance of making a costly mistake has never been higher. Here's the bottom line. The IRS didn't send out press releases about this. There were no primetime news segments, no alerts from your bank. The rules changed quietly. The grace period ended quietly, and the penalties are now being applied quietly, but you're not in the dark anymore. You know about the 25% penalty for missed RMDs. You know about the 10-year inherited IRA rule. You know about the first-year April 1st trap, and you know the 7 steps you can take to protect yourself and your retirement savings. If you found this video helpful, and I really hope you did, please hit that like button. It helps more people find this information before the penalty finds them. Share this with someone you love who's over 70. Share it with your parents. Share it with anyone who has an inherited IRA sitting in an account somewhere. This is the kind of thing that can quietly drain a retirement nest egg if nobody speaks up. And if you want more content like this, straight talk about retirement rules, tax traps, and how to protect what you've worked your whole life to build, make sure you subscribe and hit the notification bell. I'll see you in the next one. Take care of yourselves and take care of your retirement.